Good evening. So we're going to talk quite a lot on the listed property sector and the direct property market. As Simon mentioned, there will be lots of examples, lots of pictures. So all the pictures you're going to see is the pictures I've taken them myself. They're not from Google, they're from any company as well. So I like to visit assets, just tell my own story. So we'll cover all aspects of the property market, given that we've got a diverse audience. And I love property. It's my home as a career, and it's a hobby as well. And I've known Simon for over 10 years. My first power hour was in fact in 2015. All right, let's talk about the trends in the sector. So if you look at this slide, it's up from 2024. I want to start off with April 2024. It's just over the last year. You can see GNU helped the sector quite a lot. But before that, we had the sector rallying. Some of that was driven by the PIC. They bought most of the listed funds, property companies, up to 20%. And before that, you had the Fed as well, and locally as well with the interest rate cuts. So that trend is continued, and we saw a bit of volatility and profit taking at some point, and then with the Fed as well at some point, indicating that there will be fewer interest rate cuts, and they had on GNU and then VET kind of debates. But then the results have been good for the sector, pre-close updates and the result as well, and we continue to see upgrades, which I'll chat on that later on. And then the tariffs issue as well. But it seems like the market has ignored all that, and we continue to see the sector continue to go up. And over the last month or 2 months, we continue to see a good growth. And there's September rate cut expectations by the Fed, and that's boosted the market. So generally a positive story from the listed property sector. And we look at the returns over the last, let's say 3 years or 2.5 years, 2025 year to date, that's up to end of July. So August has been quite strong, so another 2 to 3% for the listed property sector. And we're talking about equities as well, they continue to rally. But property sector, generally positive, best performing asset class last year, that's the orange color, and then as well as 2023. So continues to do well off a low base. It did suffer quite a lot during the COVID era, but the sector is coming back quite nicely. So fairly good returns from the sector. But what we've seen with the sector, this talks about the inflows into the unit trust investments. The sector hasn't seen any inflows basically since 2018. It's been net outflows in the unit trust space with the retail investors. So it's mostly retail investors in these numbers. But what's interesting is that it bottomed out in 2023 with 3.2 billion outflows, and then year to date, just about 100 million outflows. So the outflows are getting less and less. So less money is leaving the sector. And we've also seen a report by Merrill Lynch, it's called the Fund Manager Survey. Most of the fund managers, they're cutting the underweight position into the listed property sector. So it's been helping to drive the sector performance. And if you look at that, it helps to bring the sector up in terms of allocation in balanced funds. At some point, 2017, during the good times, you can see that allocation to listed property over 6%, and then came down all the way to 2.75% in a multi-asset fund. And that numbers continue to increase. As at end of July, you're looking at 3.8% allocation. So that's the highest number since the pandemic. If you look at, let's say 2020, which was 3.3%. So more interest into the listed property sector, all driven by good fundamentals, which I'll chat on later on. So if there's more interest, it means it's easy for companies to go into the market to raise equity. So what we saw last year, over 13 billion rand was raised by listed funds, and in 2015, 2016, that number was about 70 billion. So it's come from those peaks of 70 billion equity raise, and then came all the way down. But now you're seeing more interest into the sector with 13 billion raised. And some of the highlights will be Vugile raised 2.5 billion, buying assets in Spain and Portugal. We had NEPI as well, raising almost 6 billion rand as well, all coming from South Africa, investing into the Central and Eastern European assets. And some of the funds or property companies, they do dividend reinvestment and strip divvies as well. We're seeing that trend continue. And then we've got the ones that do rights offers, Accelerate and Texton. So that was last year, 13 billion. And how is it looking like this year? We're seeing the momentum continue. And with almost 6 billion rand being raised so far this year. In fact, yesterday we had Fairvest, they raised 976 million rand. They were initially looking for 400 million. So it was oversubscribed, so more than twice, and then they raised 976 million. So almost at 1.4 billion rand in terms of equity raise. Spear as well. And then at Hyprop, they raised 800 million. That was to participate into the mass debacle, but that didn't work out. And we'll see what they're going to use that money, the 800 million. Even Hammerson as well. UK has been out of favor generally, but they managed to raise over 1 billion rand in South Africa. And on the left-hand side, you can see that Lighthouse, Fortress, they're all doing the dividend reinvestment alternatives, so scrip divvies. So equity continues to be raised in the listed space. Then I'll move on to the fundamentals. We'll talk about the industrial sector, the office sector, the retail sector, residential, and then a bit of student housing. Let's start with the easiest one. That's the industrial sector. It's been a perennial outperformer. It continues to do well. Looking at this chart on the left-hand side, you can see the vacancies. It's got the lowest vacancies, 2% in the industrial sector. In fact, I was talking to a couple of brokers being connected in the industry. If you're looking for 15 to 20,000 square meters of warehouse space, you can't find it anywhere right now. You have to wait for like 18 months to get that space. So the industrial sector, very strong, and it's mainly warehousing and distribution. With the industrial sector, you have to be close to the airport, close to your harbor, and then close to an arterial highway where there's an off-ramp and on-ramps there as well. So location is quite critical. You can't build industrial anywhere. On the left-hand side, that's Bash. You can see that's online shopping. They're doing quite well. I'll show you the numbers later. Then we've got GWM as well. So GWM, that's Haval, basically. So they're distributing cars here, and Chinese cars are doing quite well. I look at some numbers saying about a third of new car sales is all Chinese nowadays, and that continues to grow. And that's Attack and Waterfall. If you ask me maybe how did I take that picture with Bash equities, I like on the plane, I like to sit on the window, so I took that from the window as we're landing to get that picture. So that's the industrial sector, very solid, will continue to do quite well. Then move on to the retail sector now. So maybe let me start with, let's say, Pick n Pay. Pick n Pay has been quite topical. There are concerns over the last year, 2 years, even 3 years as well, that Pick n Pay may collapse, and then what's going to happen to vacancies and all that. But Pick n Pay is kind of holding on, and they managed to raise some money and equity to refurb the stores, but they've been closing down some of the stores as well. And some of the stores where Pick n Pay is closing, Checkers is taking over that space. Just give you some examples, local examples. We saw in even Hyde Park Corner as well, Pick n Pay left, and then Checkers just moved in. That's a sign at the bottom there. Carlton Center in Joburg, Pick n Pay left, and then ShopRite took up that space 2 or 3 months later. So that's helped as well to stabilize the retail sector. Then move on to the vacancies. On the left-hand side, the top slide, you're looking at about 5% on average vacancy rate. But we're seeing good rental growth coming through at about 3.7%. So it's more in line with inflation, more in line with retail sales growth. So it's generally positive in the retail sector as well. This is a site visit I did. It was on Christmas Eve. I was in Vosloorus visiting my aunts and cousins. So I always like to go out and see what's going on. I'm the one who goes buy meat and ice, and then just compare Pick n Pay and ShopRite, because you have to see how visible it is. That's the best trading period. On the left-hand side, that's ShopRite. I can see the queue. This is a queue to get into ShopRite, all the way outside here to this lady with the khaki t-shirt, all the way. So it takes you like hours to get out of ShopRite at that time. Not just Christmas Eve, even month end as well. Social grants are paid out. And then compare that to Pick n Pay. So these stores are like 30, 40 meters apart. Pick n Pay, you can just walk in and out, you're out in a few minutes. There's no queue at all. So you can see some of these by visiting these sites. You get a sense of how these stores are trading and how retailers trade. So ShopRite, very solid, especially in the townships and the rural areas and non-metropolitan areas. They continue to do quite well. So now we're going to talk about online sales. All of us, or most of us here, will shop online one way or another. You see all these scooters everywhere you drive. Like you can't drive even 1 kilometer without bumping into a Pick n Pay or must check a 6060, Willis Dash as well. And the numbers are actually phenomenal looking at the growth. So let's focus on the column on the far right. So online sales growth, basically using all these apps. You can see 60-60 year on year, they're up 47% in terms of sales. And then Woolies Dash 37%, Pick n Pay 49% of a low base. Foschini, we talked about Bash early on, 40% as well. So you're seeing strong double-digit growth in online sales or people using delivery apps. And then the numbers in terms of online sales as a percentage of total sales, there's no clear official number in South Africa. And talking to most retailers or retail landlords, they'll say it's about between 5 and 10%. But looking at these numbers, I believe it's probably more closer to 10% now online sales in South Africa. And ABSA had some numbers to look at their credit card transactions, that about 10% is done online and then 90% in store. So the number is closer to 10% in terms of online sales in South Africa. So the big question, what does it do as well to your physical stores? They benefit from these sales, but there's no clear lists in terms of structure, like how you structure this. And some of that can be split between the retailer and the landlord, but most of the sales will go through the till or as turnover for the landlord. So it counts as turnover growth. So the big question is, with all these apps, what happens to mall visits? What this chart shows, it shows mall visits from 2019 by different income segments. That's from light stone, low income, mid income. So your low income to mid income, since the pandemic, you can see the numbers are much lower than the peaks that achieved in 2019. So they're not going as same to the malls like before. I guess because of the economic impact, maybe loss of jobs. But on the high income and very high income, the number is actually back, is more than before the pandemic. So delivery apps, they're not severely affecting visits to the malls, because you always buy something online or 60-60 or Woolies Dash, but after work you need to pass by and get some milk or you forgot something, then so you find that people still are going to the shopping centers. This is an interesting slide. Retailers, they continue to grow their trading space. So the latest numbers from different retailers. So it's important to look at these numbers, given that you've got so many malls in South Africa, and the retail sector is over 50% of the listed property sector. ShopRite, over the last year or so, they opened 248 stores. Pepco, 168, looking to open more, 250 to 300. Pick n Pay, they're the only ones for closed stores. They closed 40. And some of them we've converted to Boxer, and Boxer is doing quite well. Foschini, looking over 100 stores in their next financial or 2026 financial year. Discount and Clicks, they're looking to open more stores as well. Their market share is 50-50, and they're looking for more space. In fact, Discount said that they can't find enough space or the right space for them to expand. So retailers need more space to keep operating. And then who else? So we're also seeing pharmacies as well. Discount and Clicks, they're looking to open more pharmacies. Difficult to get the pharmaceutical licenses, but that's one of their growth areas. As well as the other one is actually liquor stores. Takes time. You always find the mall opens, Checkers open, but liquor stores don't open yet. Also takes time. That's another growth area for the retailers. Some of the examples, I drive around and look at all these sites. That's Johannesburg. LXX celebrating 1 year. And then we've got Mushroom Farm coming up. That's on Allendale Road, closer to Kyalami racetrack, and between the off-ramp, Allendale off-ramp, and Kyalami. So somewhere midway there as well. The center is opening soon. And it's all driven by there's so much residential coming up. Go to Midrand every 2 months or so. Every time you go there, there's either something breaking ground or another apartment opening as well. So huge growth coming up there. So to save that market. The interesting one is this one on the right-hand side, the Sandton Gate on Winnie Mandela Drive, former William Nicol. Also another shopping center coming up. You can see the names there as well. Woolies, Discam, Checkers, all looking to open. And this was a report done by the South African Shopping Center Council last year. Over 100 new shopping centers are coming up in South Africa over the next 2 years or so. And some of them, these are the examples. And Cape Town opening a new mall as well. That's Grand West by the casino there as well. If you've been to PE or Gqeberha, it's the same as the one that's in PE as Boardwalk. So it's the same developer coming up with that concept where they open malls within the casino areas. So more coming up in the retail space. So driven by retailers as well as landlords and developers and your council as well. They will want to have commercial areas that get more rates and taxes. So not only are they opening new stores, retailers, they're opening new concepts. Woolies, we saw WCeller being a separate standalone store. Checkers with unique clothing. then Absolute Pets as well. Your pet shops are doing quite well nowadays. You need to have a pet shop. Every mall is becoming like an anchor nowadays. It's unbelievable. And then on the right-hand side, that's not a picture that I took. It's from Foschini. They didn't want to tell me where they're opening the stores. So they're opening the first store in Gauteng. It's called Beauty Box. They're going to open much more stores as well across South Africa. So it's a different concept, just a beauty on its own. And as I mentioned earlier, when you saw the numbers, Foschini looking to open more stores, that's part of the Foschini expansion. So watch out in Gauteng this week sometime. I don't know where. I asked them at the Shopping Center Council conference. They couldn't tell me where, but I'll look for it and then see how that looks like. So if you talk about, let's say, so let's look at population, see which areas are growing, which ones are going backwards in terms of population growth. So what this slide shows from urban studies is that Gauteng is still growing. As you can see, population growth between 2021 and 2026, almost 830,000 people moving into Gauteng. So basically Western Cape and Gauteng. And who's losing out? It would be Eastern Cape and Limpopo. So it also helps to support that while we're seeing more shopping centers coming up in some of these areas like Gauteng, there is population growth driving that. So other thing to think about as well is that when people move to the cities of Gauteng or Western Cape, they still have to send money back home. That supports your rural areas, your townships in those areas as well in terms of sales growth. And later on, when people have worked in this in the urban centers, they'll go back and retire and continue to build. There's still activity across different segments of the country. And where there's actually big growth in the property sector is the township and rural areas. That's where the population is. That's where the growth is, and we're seeing more listed funds buying assets there. We had Dipula, they announced last week they bought Protea Gardens Mall for 480 million at over 10% yield. Even Spear as well, they bought Maynard Mall in Wynberg, kind of a similar dynamic at about 9.5% yield. So more acquisitions into this space. And so this picture on the left-hand side, it's actually a queue going into PEP. So the queue is so busy inside that they can't accommodate people inside. They will tell people to go outside and queue. That's when the schools are opening. It's unbelievable when you see this as well. For month end, schools opening and holidays. Who else? Okay, and then Soshanguve, Alex as well. These ones continue to trade well. Exemplar, they own mostly township retail centers and they do quite well. Very solid company. Only if you could get liquidity tightly held. This is an example as well, talking about social grants. I took this picture. We're in Cape Town. This was on the eve or deadline for the black cards, SASSA cards as well. People travel all the way to different areas, sleep at night, 2 days in the queue as well to get the new card. And probably going to see more queues now because they're moving to the biometric system. But this is a very strong part of the economy. To give you an example, I saw somewhere in the business day that in Eastern Cape and Limpopo, 40% of the population, they've got social grants as their primary source of income. So that also goes into the retail space. So let's get questions on Accelerate Property Fund. This is the biggest mall in South Africa by size, Fourways Mall, but it's small in terms of market cap, but attract lots of headlines. So I thought we'll talk about it. So it's changed asset managers over the last year or so, and you can see the difference, like small things like this. This was, I took this picture 3 years ago. No signage, you get lost there as well. Like I understand how malls work, but you get in and out of Fourways Mall, you get lost. So what they've done now, they've improved the signage, even just the views. You can see the Fourways Mall as well, landscaping, all that as well, and vacancies are coming down. So, and the banks have helped this mall just to keep going. Others have been tough for Fourways Mall, but you're seeing vacancies coming down. Even the plane, I haven't seen it now, is working there. You can go and visit that as well. So that's Accelerate Property Fund, as it attracts lots of headlines. Then move on to the office sector. Office sector, that's the most challenging sector, but it depends on where you are. Let's see. If you're in Cape Town, not a big issue. You can see Cape Town vacancies came down from about 14% after the pandemic, all the way down to 6%. So Cape Town is basically fully let in terms of the office market. I guess it's economy, it's immigration, tourism, as well as call centers, your business process outsourcing centers opening in Cape Town. So they've taken up all the space. That's why Cape Town is doing quite well. Whereas Joburg has been lagging, sitting at about 16%, almost 17% vacancies. Even areas like Sandton City or Sandton CBD, almost 20% vacancies around that area. So office market, very challenging, but you're seeing vacancies start to come down and rental growth not as bad as before. Just give an example like how strong the Cape Town office market is. If you're in the waterfront, V&A waterfront, Claremont, so most of the asset managers are, rentals are over 350 Rand a square meter. And so the rentals continue to go up if vacancies are low. And you can see that CBD on the right-hand side, well maintained, the security every corner, with the City of Cape Town Improvement District. It's a very strong market in Cape Town. And that's why probably some of the big corporates, global corporates like Amazon, they've chosen to be in Cape Town. They're moving, that's the head office is coming up on the left-hand side in this mixed-use development being done by Zenprop. And then move on to Joburg. Joburg, it's a very big city, lots of economic activity. But what I've seen over this year and the last year, lots of headlines around Joburg. There's willingness to turn around Joburg, to fix Joburg as well. Even Baldwin says just here on College Drive and in M1, say make Joburg great again. But that's going to help Joburg. You're seeing potholes getting fixed, traffic lights here and there as well. So G20, probably a big thing to happen for Johannesburg. The city just needed that as well. And what else? All these debates about mayors, because every year, 1.5 years, there's a new mayor. That's causes all that instability in Johannesburg. Joyless in Jozi. On the right-hand side, that's quite critical. That's Leland Ngoyi Street in the CBD. We saw some announcements saying that street is going to be open end of August. So phase 1 should be open. So keeping fingers crossed, I'm going to go and check at the end of August and see what's happening. So I actually took this picture. That was 31st of July. So it didn't show that it might be done by 31st of August, but I saw the announcement from mayors is going to be done. Why is it critical? A lot of listed funds have got exposure here. Octag has got over close to 15 properties around this area. So if the road is blocked, you can't trade. That's a problem. SA corporate with residential in the Joburg CBD as well. And it's also an example. When it's done, we're hearing that Octag mentioned that last week that some of the retailers going to be new for the CBD in Joburg. Retailers are starting to look at this and say, can we open maybe stores here? So we'll watch out how that develops. But the willingness to fix Joburg is there, and G20 game changer. Then move on to the residential sector. So we talked about the office market in Joburg, Sandton at some point over 20% vacant. We've seen private landlords and listed landlords buying some of these buildings and then convert them to residential. If you recall, on the left-hand side, this used to be the Absa Towers head office there. You can see Transit or Carlton Center behind there as well. This is all residential now. All residential. That was owned by Growthpoint, Sandton CBD. Africrest bought that and they're converting that to residential. So at some point in time, you'll buy some buildings, then there is extra bulk. They add in 1 or 2 floors as well to make it more viable. Because the biggest challenge is that some of the landlords don't want to sell their office buildings at 50% less. So, because it will bring down the valuations, but there are opportunities where you can pay almost full price, but with extra bulk. And then in Sunning Hill, you can see that you can stay even up to 3,150 per month. So it's attracting different people, become more mixed use area around these areas. It's not stopping there as well. There's more coming up. There was an article in the Sunday Times, I was quoted on there as well, that whether it's Ndlovu, Bryanston, Randburg, Rivonia, you're seeing lots of new developments coming up. This is on Marlborough Drive and Catherine. Yeah, you can see quite interesting. It says, Sandton living is so good that your ex will text you back. So I'm going to see the site on Friday, go with the developers, see what's going on. It's going to be amazing, phenomenal. They're doing extensions as well. It's going to be huge development coming up. And I also saw as I was driving down over the weekend on it's kind of Greyston and Catherine, there's another development where they're converting, which is former City Lodge. It's going to be residential as well, mixed use by Africrest. And then close to us here in Ndlovu as well, that's International Housing Solutions as well, doing a conversion, used to be owned by Fortress Income Fund, being converted into residential as well. So there's lots of changes happening in this space. This was done by FNB, looking at some of the office sales or office buildings being sold. So if they're being sold by most of the listed funds, what are the buyers looking to do those buildings? In the greater Johannesburg area, almost 38%, or 38% of the buyers, they're looking to convert that to residential or mixed use, which speaks to that what I mentioned earlier on, whereas total number across South Africa, about 19% going into residential conversions. But Johannesburg area, much bigger in terms of conversions. So you'll see a lot more of those. Not just the low end, let's talk about the high end. High end also doing quite well, but I guess you don't have as many buildings like in the lower end. because the apartments are more expensive. On the right-hand side, that's Growth Point. They've partnered with Tricolt, 1.5 million to 7.25 million for apartments, and then penthouse from 14 million to 100 million. And interestingly, this phase one was actually sold out, 90% sold before the launch. And most of the buyers are local buyers. And so they're now on phase two. Phase two is about 50 to 60% sold. And that's in Sandton. And then on the left hand side, that's Waterfall City, that's Attack, Ellipse, and then Aspire. Aspire is a new one. This is Aspire. That's about almost 50, 60% sold as well. Whereas the first one, it is probably more for people buying to live there. These people are buying for investment. So lots of developments in the upper end of the market as well. Then move on to student housing. This is a very good sector. Demand far exceeds supply. But the biggest issue here is NSFAS. NSFAS, I guess, payments. You don't get probably paid on time. It's number one. And we've seen lots of changes in terms of the board and management. So this hasn't been stable. You eventually get paid, but it's difficult as a developer or landlord where you can't actually time your payments well. And also they changed the allowances, which used to be 45,000 per student, then went up to 60,000. Then you developed based on 60,000, then comes down to 45,000. So it's built already, so then it doesn't work out well. So that number has gone up to about 50,000. So it's just instability with NSFAS, but the sector on its own is very solid. That's Octodec. They own one of the buildings. It's mixed use, students and other people. And then Thrive, that's Growth Point. And then Rise, that's Momentum and Aries Property Group. Aries Public used to be owned by Redefine. They sold their student housing portfolio. So talking about more challenges for the sector, we all feel it as well as individuals. So if you look at this, say your total municipal charges, electricity, including electricity, they make up 62% of operating costs, and they continue to go up. Just give you an example, let's say municipal charge as a percentage of gross income, on average about 27%, but let's say in 2008, 2009, it's about 12, 13%. So it's more than doubled as a percentage of gross income. And that's the challenge with landlords, because most of that you have to pass on to the tenant. At times, if you can't pass it on to the tenant, you have to actually bear that cost as a landlord, and that's the biggest challenge. And it's not like you're getting, say, you're getting a bang for your buck. You're not getting some of the services as well, but this continues to go up. That's the biggest issue right now in the property sector: the rising operating costs, electricity, municipal charges. And the other one, just for illustration purposes, security. You know, security crime just continues to worsen. So landlords have to spend a lot of money fencing buildings. If you've realized, actually, when you drive around 5, 6 years ago, even 10 years, most places were not fenced. But now you can see clear view signs everywhere. You have to fence it. Even this building as well, when it opened, it was not fenced. Yeah. So you spend the money on fencing. This costs money, all the signage as well. You have put an extra security person as well to watch out people are going in and out of Ubers as well. So landlords, they're spending a lot of money as well on security for a pleasant experience. Because if you've been robbed, it's not nice. You might not go back to that place for some time. So that's one of the issues, but lots of investments there as well. They're also investing as well. The biggest challenge, water. We've had that. One of my colleagues actually works at Standard Bank last week in Sandton, Central Sandton CBD, no water for 3 days. You see, you expect that. And then you can see all these water tankers going to the hotels, conference centers as well, because they need water. Without water, you have to close down offices. You can't operate. When they go to licensing department, half the time you go there, then it's closed because there's no water. So water is quite critical. And it's good to see that I can see Joburg Water doing some repairs, Metron Depot there as well. It's been a big issue. So most landlords are investing in backup water. Currently, it's 2 to 3 days backup water. They're investing up to 5 days backup water in this space. Load shedding not a problem, but load reduction remains a problem, especially in the townships and rural areas. Half the time you don't get electricity, which is a problem, and you have to spend money as landlords. These are examples of what the landlords are doing to counter water outages and load shedding. You can see the Nexus building. That's quite sophisticated. Steel water tanks, sectional water tanks by Attack. And then that's Alex Mall. Exemplar told me that they've got more fancier water storage capacity than this in the buildings as well. But the Georgia tanks, lots of them as well. And every building nowadays, you need to have solar. So there's solar everywhere you go, and you can even go vertical, like what Fairvest have done there. I've never seen that in most buildings, but solar is quite critical. to a point where some of the companies like your resilience, over like 30%, 40% coming from their backup power. So lots of investments going into this space. So I've talked about local markets, and now we move on to Central and Eastern Europe, which is quite a big sector for us South Africans. We've been probably the first mover after the global financial crisis into Eastern Europe. NEPI was born out of South African money, and there's more other companies going in there as well. So now if you look at the companies on the JSE with CEE exposure from NEPI, Rocastle, MES, GTC, Fortress, Castle View, they're all going into this market. Hyprop, Growth Point as well. It's where the growth is. These countries continue to grow, and retail sales have been quite strong as well. And we see more investment into this space. So CEE and also Spain and Portugal. And most of these companies are invested in Poland. All of them have got Poland exposure except, say, Hyprop. And Poland has been one of the fastest growing economies in the world for quite some time, growing at 3–4%. In fact, Poland, Warsaw, the capital city, has overtaken Frankfurt as a city in Europe with the highest number of skyscrapers or high-rise buildings. I went to Warsaw, like that was in June, so I couldn't recognize some of the areas because last time was in 2019. It's changed a lot, continues to develop. That's why most companies go into this space. Some of the site visits, NEPI Rocastle, as we mentioned, that's the biggest listed property company on the JSE. It's by far the biggest and it's done quite well. And they're all in these markets from Croatia, Romania. So visit these in three days. At some point, actually one of the days, I always joke that we had breakfast in Croatia, lunch in Hungary, and then dinner in Poland. So just moving all around just to see these assets in a short space of time. So with that cash they raised earlier on, they bought Magnolia Park and they bought Celestia City Center. And then they're doing a big redevelopment here. So in fact, this building is going to have probably the basement, probably the biggest basement, like it's lower than any other building in Europe or continental Europe. That's how big it is. And NEPI Rocastle is the third biggest retail-focused stock in continental Europe after Unibail Rodamco and Klépierre. So it's a very big company. And they went to Poland, that's Fortress. They mainly own retail here and then industrial or logistics. They're going to Poland, building this. They've set a platform there. And they've got buildings where you've got extra bulk. They're extending there as well. But Poland might take time in the industrial space. There's lots of buildings, lots of land available. And we believe that probably 10% of the assets are up for sale. So we need to see that sale process go through before you get upside or proper upside from these investments. And they went to Macedonia, not Macedonia. So-called Macedonia anymore because the Greeks didn't want the name Macedonia. They had to change to North Macedonia because Greece and Macedonia are fighting there. That makes up 32% of Hyprop's portfolio and 40% of income. If you want more detail, you can check the Hyprop website. I wrote an article on Central and Eastern Europe and opinion piece. But these centers as well continue to trade quite well, and they're expanding, re-tenanting. We're getting more retailers coming through into these markets. And then probably the more popular markets nowadays is Spain and Portugal. So Virgil is going to these markets, raised a lot of money, and they're buying these assets, perhaps somewhere between, let's say, 8 to 9% yield in Spain and Portugal. Where South Africa, you're looking at about 8% for good assets or even 7%. So buying at 8 to 9%. And then Lighthouse is buying at probably 7 to 8%. And these assets, some of them, they need to be refurbished, repositioned, re-tenanted. There's good growth potential in Spain. And Spain is boosted by tourism as well. Tourism is quite big in Spain, as well as agriculture. And we're seeing strong growth there. And then Lighthouse, as I mentioned, also quite big in this space. They were the first mover into Spain and Portugal. And you can also get Lighthouse exposure through Resilient. Lighthouse makes up 12% of Resilient's portfolio, and then 17% combined, because they also share some direct assets as well. And their big focus for them has been the Inditex group as tenants, which has got Zara, and that's one of the best trading retailers. And they've been buying assets quite prudently, about 7 to 8% yield. So why Spain and Portugal? If you compare Spain and Portugal in terms of retail density, that's your GLA, the square meters per 1,000 inhabitants. So you can see America or USA has got much higher retail space, followed by UK, just some examples, but there's Spain and Portugal at the end as well. Not much retail space available. So the markets evolve, they change, and then you find that there's need for actually more modern retail space as opposed to just saving markets and that. And then move on to the JSE. JSE, as we know, there's been lots of delistings happening. So what we've seen in the on the JSE over the last 2 years or so, more UK companies coming to list on the JSE, secondary listings. So supermarket, REIT, Assura, then primary health properties, and then some delistings as well. So UK used to be quite big, and then we might see that Assura delist after being taken over by PHP. And I talked to the German REIT, DKR, that's Deutsche Konsum. They're looking to delist from the JSE. They're saying they haven't got the benefit of listing on the JSEs. They're waiting for one shareholder who has to cooperate with them for them to delist. So one less stock, probably 2 less stocks come out of the JSE, which is a challenge for the property sector. So we'll talk about indices now. Indices like your SAPI, that's SA-listed property index, it's supposed to have top 20 stocks. It's got only 17. So which speaks to that around delistings. And then the all property index had in 2017 33 stocks down to 22, and then property stocks on average down from 56 to 42 over the last few years, with a few more likely to delist as well. So probably need more listings on the JSE to have more choice. On the other side, we've got the unlisted REIT still being discussed, not finalized. Got this from Java Capital. The Income Tax Act has expanded the definition to include REITs from the 1st of January 2025. So it's recognized from a tax perspective, but waiting for National Treasury to publish the terms, the conditions, requirements as well to qualify as an unlisted REIT, which is good for market activity for the private landlords and listed landlords as well. And also, we also need actually to have a regulatory body. That's what the National Treasury will require, and also to incorporate the coffee bill, which is still being discussed as well. So this might take time, but it should be positive for the sector, because you know with the REIT, there's no tax at REIT level. So the tax is at the hands of investor or need disinvest. So we've done JSE, then move on to the debt market. So the debt market, corporate debt market, unbelievable. Like the listed sector, lots of money being raised in this space. So if you look at 2023, 41% of the debt issued on the JSE was from property companies. So my property sector is quite small, but 41%. And then year to date, about 30%. We had Vukile, that was on Friday. They raised 500 million. Normally they raise about 500 million, just 6 times oversubscribed because of shortage of debt, actually available debt instruments available, 6 times oversubscribed. Even the margins, they'll compress. What they were looking for was actually much lower than that as well. So you see more companies going into this market to raise a cheaper debt. Then talk about earnings outlook for the sector. So now go into individual stocks. We start, let's say with Attack. I work with Attack on the board and the Attack Waterfall Investment Company. I chair the board and the investment committee as an independent non-executive director. I've been with the group for the last 2 years and continues to do quite well. It's been solid in terms of performance over the last 2 years, market outperformer. And then Fairvest, that's Township Retail, and they raised money yesterday, 976 million, looking to buy more centers around that. Resilient as well, not only just Spain and Portugal, but they focus on the Township, rural retail, and non-metropolitan centers. Vukile, same thing as well, Fortress. And then that's Storage that does well, and then Equities. These are very specialized companies that do quite well. And Spear, that's Western Cape, they continue to grow. So on average, you're seeing earnings improve in the sector, and most of the earnings upgrades coming through. In fact, today as well, Redefine upgraded their guidance. They had 0 to 6%. Now the number has gone up to 3 to 5%. So not 0% growth anymore, because letting activity has improved. Same as Octodec, they've upgraded the guidance. That was Friday or Thursday last week as well. So you're seeing more earnings upgrades coming through from the sector. Not just about interest rates, also because of underlying performance and letting activity. Hyprop is only one that's negative because they raised 808 million, hoping to participate in mass, and now they're sitting with that cash, and that cash is dilutive. Let's see what they do with the cash. And then on the no guidance side, that's Accelerate and Delta. They've had a tough time. Accelerate, that's Fourways Mall, and Delta, they've had government tenanted offices, but both of them have been selling buildings to help reduce their debt. Example, they just choose not to disclose their guidance, but they're quite solid, strong operator, even doing double-digit net operating income growth, as well as the Safari as well playing into that space. Then I talk about the metrics for the sector. The sector, what you're looking at is that loan to values have come down from about 44% at the peak during the COVID era. 44% has come down to about 38%. So most of the companies prefer to be below 40%, but it's not just about the LTV level. You have to look at the interest cover ratio. Because talk about LTV rate, banks require LTV to be below 50%. So the sector is comfortably below 50% at 38% LTV ratio. And then interest cover ratio, you need to have a minimum of 2 times interest cover ratio. That's your ability to pay your interest. So the sector is sitting at 2.4 times. So as earnings improve, interest rates come down, you see that interest cover ratio improve. So in terms of balance sheet, the sector is quite solid from that perspective. Discount to NAV, at some point, the NAV went up to over 55 to 60% in some of the stocks during the pandemic. It's come down to about 19% for the companies in the domestic space. And one thing to watch out for now is that payout ratios. The sector used to pay out 100% of its earnings to investors as distributions, but now you've seen that number come down to about 85, 86% to retain some of the money in terms if it's difficult to raise capital. And then for capital expenditure, whether it's generators, backup water, and that as well. So you need to retain some of the money because it's not as easy at some point to raise money like before. And then earnings growth. Look at how big that shift is. From -3, -4% last year, and then this year looking at 4 to 5% positive earnings growth. And there's potentially upside surprises in this number. As I mentioned, over the last week or 2 weeks, you're seeing more and more listed funds upgrade their guidance. And then from a yield perspective, that's a historic dividend yield. On a forward yield basis, you're looking at about 8.1, 8.2, if not 8.3% forward yield from the sector. So that's your dividend yield. But then in terms of earnings yield, the sector is about 9.5% thereabout. So still slightly below the 10-year bond yield. I don't know where the bond yield market is now. It's about just under 10% or 9.8. But then you're getting growth now. Whereas before there was no growth, that's why the sector struggled. So much more positive. In terms of fixed rate debt, the sector is fixed about 78% of the debt. And then 22% that's floating is one that benefits from lower interest rates. So if it's 25 basis points, might not be big, but it helps to boost the earnings for the sector. So lower, so that's helping quite a lot. And then on average, the debt is fixed for about 2.5 years, 3 years. So, but 20% or so rolling over every year with lower interest rates. So this year is the year we're seeing the full impact of lower interest rates. Taking time because most of the year was at high levels. Now this year, that's helping out when you see more rate cuts from the sector. And then, so this was done by Citywire. It's a survey they do every quarter. Just get a sense of where fund managers are sitting or investment teams across South Africa in terms of property allocation. So 16% saying they're looking to decrease property exposure. And I've got 84% basically saying that they're happy with their property exposure right now. So which basically means that property sector is a hold, and none are looking to increase their exposure. I guess sector has rallied quite a lot, but there is opportunities within the sector if it's stock rotation from different markets and then growth rates, especially given that there will be upside in terms of earnings growth. And then the concluding slide. Upside and downside risk for the sector. So on the positive side, I guess you just need GNU to stay intact and then growth improves. And then the grey listing as well, the market is watching out for that. So we'll see by the end of the year if it's going to happen. And what's also been helping the sector, which I didn't touch on earlier on, is a two-pot retirement system. So all that small cash, extra cash withdrawals, some of that goes into the retail sector spending, helping to boost some of the sales for the shopping centers. Fundamentals, they're improving across all sectors, including offices. So like offices, what's helping the office sector as well is that where there's been high vacancies, for example, in Sandton, the buildings are being taken out, being converted into residential. So there's going to be less space available going forward. And then positive dividend growth, whereas last year was difficult for people to allocate to property because your earnings are going backwards, but now your earnings are going positive, 4 to 5% and above inflation rate or official inflation rate. On the downside, I guess it's all about interest rate cuts. Are we going to get another cut? And it's taking longer than expected. And municipal charges, as I mentioned, that's the big issue for the property companies, and infrastructure and crime as well. Like if you've got a building, then you've got to look after your surroundings to make it attractive for tenants to come into your space. If you don't, you might lose out on tenants. But there's a big push across the country to improve that. Water outages, load shedding, that's one I charge for. And then GNU is quite shaky, you don't know what's happening. And then if all that changes, or let's say GNU collapses, investor sentiment will shift to offshore investments. And our sector, over 50% is exposed to the offshore markets. So you're still getting that benefit by being in the local listed property sector, where there's diversification mainly in Eastern Europe, and then Spain and Portugal, a bit in the UK and Australia. So with that, I conclude the presentation, and thank you for listening. Yes, because of capital. Yeah, so capital, that's number one. And two is that the market understands. If you go across the UK, Europe, they understand the South Africans. We love offshore exposure, love European exposure. In fact, it's us going to look for those opportunities to bring them to list here on the JSE. So it's all capital driven, and remember, they're all secondary listings, they're not primary listings. Yeah.
Just big tanks in the basement.
Yeah, yes. So what it's easy, depending how you do it as well. As I mentioned, Georgia tanks, but then can have more sophisticated as well. Because more like when there's water outages, the other challenge is water pressure as well, to get the pressure all the way up to the building. So that costs a lot of money as well to bring the water all the way up to third, fifth floor, or even let's say your tanks are upstairs as well. So there's more investment required into that, as you saw with those steel water tanks, because it's going to be a problem that's going to be there for quite some time. You can't solve it overnight, so you need to invest a lot more as well. So I guess probably with power, the difference is that you can still operate without power. Without water, you cannot operate at all. Your bathrooms are closed. I remember actually here in Rosebank when I had a meeting, we had to cancel a meeting because we meant to have a lunch at one of the restaurants. They didn't have water. They said you can only have takeaways and you leave as well. So UK, Shaftesbury is doing quite well in central London, West End London. That's one stock that's done quite well. So it's all about location. So it's basically, you want to be in London as opposed to probably other markets. And they've got Hammerson as well, as we saw with that equity raise, raising over 1 billion to buy the Botton Asset Bullring, that's the mall, in the higher income upper end of London. So Hammerson's coming back. So the UK suffered quite a lot because of the growth in online shopping. As you know, we had casualties with Into as well, all these companies delisting. And then so now we've probably reached the, it's kind of plateaued in terms of online shopping impact on the retail centers. So yeah. So it's still worth it, probably selective on the stocks, Hammerson, Shaftesbury. And then we've got storage, South African company with storage exposure. They're exposed to the UK market, and then it's been quite slow over the last year or 2 years, but now it's stabilizing. So storage, they've got exposure in the UK, and storage market takes time to settle, but that's one other stock to look at. Yes, yeah. So it's a challenging one. So what you're finding is that there's always a shift. So you have to have the latest concepts. When talk about the retailers, you want to be in malls where the retailers have got the new concepts, latest stores. You want to be there. And you have to invest in the centers. So the smaller, weaker ones will suffer. So those 100 new centers coming up, it's not like it's additional shopping centers, others will suffer. And what you're seeing as well in some markets is that there's a shift away from the CBDs. And then like in smaller towns, you find that there was a high street operating, but all the retailers are leaving that space to go outside into the new mall. So there will be casualties, but then you want to be where the retailers are. As you mentioned, that retailers continue to open more stores, even in some of the new malls as opposed to the old malls. Yeah. But rental growth still generally positive, about 4%. Yeah. Yes, okay, the market will price in some of that growth. What counts more is that the earnings upgrades where the market doesn't know. And what you find with most companies, they prefer to, what do you call it, under deliver, and then surprise with actually higher numbers as well. Okay, so maybe, yeah, that's a tough one because it's unfortunate since the launch of the GNE, there's always been debates and fights, all that. But if you look at it as well, we've had so many issues going on, it's probably in the interest of the country as opposed to individual parties to keep that going. Yeah. So if you look at that, the listed sector, it's active. Even if you've got land, it's set aside for development. There's activity going on. So it's different to, let's say, the land that's just lying idle that could be a target for being expropriated. But the sector, there's probably minimal risk in my view. Even some of the landlords with bulk or extra land, they've got plans to do something like that. And remember, it's commercial. You're creating jobs, bringing people there as well. And talking about international investors, our sector, we don't have much international investors in the listed property space. So most of the investors, there are a few active ones, but most of them be index trackers, where they buy through the indices and then track the index. So it's mostly domestic, and there's just a few international investors. I guess also different that liquidity and size of the stocks as well, probably not as big enough for some of them or the big funds. Yeah.
Nice question. Mm-hmm. Of course, did Trump expropriate Intel or not?
Yes. Okay. There's probably one sector I didn't talk about. It's data centers. There's always question on data centers. So it's a growth area, but what you find that in the sector, to have a separate data center company is probably not easy. One, because of valuations. The valuations you're looking at probably 5-6% yields to make it work. And then with data centers requires proper connectivity. You require lots of water supply, and you don't have much water, and then lots of electricity as well. So you have to invest a lot in that space. And then what you find is that most of the players, like your Microsoft, is that they prefer to own their own data centers. So they are here in South Africa, and they're all privately owned as opposed to being in listed entities. Yeah.
Are there any international REITs that invest in data centers?
Yes, yeah, they are. Yeah, in the US quite a lot, in the US as well. Yeah, so that the separate segment of property sector is just data centers in the US.
Careful of data centers, though, because they've got cabinets.
Yes.
That fancy chip or whatever thing, computer thing that you plug in today, in 5 years is no longer fancy.
Yeah.
Maybe you could take that into cold storage or something, but there is a lot more. I was doing some digging a couple of months ago. Because I thought data centers were a no-brainer. And there was one in particular, I forget the name of it, but they're spending like 15% a year just on capex, just on renewable to keep those going. It's one of the reasons, Keillen, we don't have, if I look at America, we've got so many sectors.
Yes.
We've got hospitality, health, data, towers, etc., etc. Our market's just too small for that. I mean, we've got storage and bits like that, but we're just a relatively small market. We can't sort of absorb it perhaps.
Yes, so it's the size of the market. Yeah, so I guess the only market where it's possible to have a listing would be the residential sector, with all these companies building lots of resi apartments across the CBDs and everywhere else. It could be the next that comes back to list.
Is Growthpoint going to list there? Residential.
So they've got student resi. They mentioned that probably in 5 years' time or so, they need to bulk it up, make it bigger before they list it. So the separate student housing, and then we used to have residential. By that point, like 3-4 years ago, it wasn't a sector people understood. And now you've got the SAMRA, called South African Multi-Family Residential Rental Association. So there was limited data. You didn't know what you're investing in. And perception of the residential, I think there's lots of areas and vacancies. But most of these portfolios, vacancies are less than 2%. Areas less than 2% as well. Because if you think about residential, things can get tough, but you don't want to give up the space that you live in. You can cut on everything else. You can sell your car. You can sell some of your furniture, but still stay somewhere as well.
The guys are not too optimistic, and that's what they say.
Yes.
People will cut back on things, but they need to live somewhere. In many cases, they're working in the area. It's not like they can go back and live at home because that then transport problem. But I like your point around they've got a lot of buildings down in Joburg.
Sure.
We'll go this weekend and see if they've fixed the road.
Yes, that's right. Yeah, 31. That's the deadline. That's right.
Sundays.
Yes, right.
We're going to park it there, gentlemen. Lady, really appreciate the time. Keillen,
good. Thank you. Great. Appreciate it. Great.